Most business owners wait until tax season to think about taxes, and that's exactly why they overpay. If you want to legally keep $10,000, $20,000, or even $50,000 in your pocket, the deadline is not April. The real tax deadline is December 31st. My name is Henok Kebede. I'm a CPA, and I help business owners save 5 to 6 figures in taxes every single year by using the IRS code exactly the way it was written. If you're a business owner who's tired of donating money to the IRS, this video is going to change the way you look at year-end. Today, I'm going to break down the 5 most important tax moves you must consider before December 31st with updated 2025 limits, the impact of the One Big Beautiful Bill rules, and the real strategies I use with my own clients to legally lower their tax bill. If you implement even one of these before the year ends, you will feel the difference in April. Let's jump in. Move number 1, accelerate your expenses and delay income. See, one of the most powerful year-end strategies is incredibly simple. You accelerate your expenses into this year and delay your income into next year. Here's why this matters. If you're on a cash basis accounting, which most small businesses are, the IRS only taxes what actually hits your bank account before December 31st. And it only allows deductions for what you actually pay out before December 31st. So if you can legally push income into January, it's not taxable this year. And if you pay qualified business expenses before December 31st, they are deductible this year. Right now, before the calendar flips, here are the kinds of things you can look at. Paying January's office rent early, paying contractors you already owe, prepaying part of your marketing budget, renewing annual software subscriptions you know you'll keep anyway, or handling repairs and maintenance you've been putting off. On the income side, if you're trying to keep this year's taxable income under a certain threshold, you might invoice a client now, but let them know payment isn't due until early January. As long as you truly don't receive the money until next year and you're on a cash basis, that income usually belongs to next year's tax returns. The mistake a lot of business owners make is waiting until December 29th and trying to jam everything in. Don't do that. These payments need time to clear, and you want your books clean and accurate, not chaotic and last minute. Move number 2, use 2025 retirement and HSA limits intentionally. If you want one of the most IRS-friendly ways to lower your tax bill, here it is. Actually use the contribution limits the IRS gives you. For 2025, here are the big ones to be aware of. If you're a solo business owner, a solo 401k can be incredibly powerful. The total contributions that your employee deferral plus your employer piece from your business can go up to $70,000 if you're under 50, with additional catch-up for contribution allowed if you're 50 and older, including an enhanced super catch-up window if you're between 60 and 63, depending on your plan. If you use a SEP IRA, employer contributions can go up to 25% of eligible compensations capped at $70,000 for 2025. For traditional and Roth IRAs, the combined limit for 2025 is $7,000 if you're under 50 and $8,000 if you're 50 and older. And one of my favorite accounts, the HSA, has a 2025 limit of $4,300 for self-coverage and $8,550 for family coverage, plus an extra $1,000 catch-up if you're 55 or older and eligible. Now, do you have to max out all these? No, most people can and they don't, and that's okay. But even putting $3,000 to $5,000 into the right account can save you hundreds or thousands of dollars in taxes while building your future. And a quick note on timing. Some of these contributions, like IRS and SEP IRAs, can technically be made until you file your taxes, right? Until tax deadline. Others, like 401k salary deferrals, have to run through payroll during the year itself. So the point of talking about this now is that the planning and cash flow decisions really need to happen before December 31st, so you're not scrambling later and missing your window. If you're not sure which account gives you the best bang for your buck, that's exactly the kind of thing you want to talk to a tax strategist about before the year is done. Move number 3, use the Augusta Rule correctly up to 14 days tax-free. See, every year I help business owners legally move thousands of dollars from their business into their personal pocket tax-free using something called the Augusta Rule, also known as Internal Revenue Code Section 288G. Here's what the rules say in plain English. If you own a home that you use as a residence and you rent it out for fewer than 15 days during the year, so 14 days or less, the rental income from those days is excluded from your taxable income. You don't report it on your personal return, and it's tax-free at the federal level. Now, here's where business owners get excited. Your business can rent your home for legitimate business use. For example, strategy meetings, board meetings, planning retreats, filming sessions, or client events, and take a business deduction for the rent, while the income you receive personally for those days can still qualify as tax-free under the Augusta Rule, as long as you follow the rules. The key requirements are, number one, you stay at or under 14 days total for the year. Number two, the rent you charge is reasonable and in line with market rates for similar space in your area. Number three, the primary use of the property is personal, not full-time rental. Number four, you keep documentation, agendas, calendar invites, minutes, an actual invoice from you to your business and proof of payment when you do this correctly. Your company records a normal rent expense, which reduces your taxable income, and you personally receive that rent without having to include it in your income for those days. But this is a calendar year strategy. The meetings, the invoices, and the payments all have to happen during the year you want the deduction. Once December 31st passes, you can't go back and invent an Augusta Rule meeting for that year or for last year. So if you're going to use this, you want to plan it before the year end, not after. Move number four, smart charitable giving and donor advised funds. Let's talk about charitable giving, because when it is done strategically, it lets you support causes you care about and reduce your tax bill in the same move. First, the timing. If you want charitable deductions for this tax year, the donation generally has to be made before December 31st, not when you remember it in February. If you're someone who gives regularly or you're having a particularly high income year, consider using donor advised funds or DAF. With a DAF, you make one large contribution now. That's when you get the tax deduction. And then you can recommend grants to various charities over time in the future years. So you might decide in December, I want to give $20,000 total. Contribute that to the DAF before the year is done and lock in the deduction this year. Even if you don't decide which non-for-profits get what amount until later. The important part for taxes is, number one, the organization that receives your contribution, whether it's a DAF or whether it's a DAF sponsor or a charity directly, needs to be a qualified 501c3. Number two, you need proper acknowledgement or receipts. And number three, you want to coordinate your giving with whether you're taking the standard deduction or itemizing, especially under the new rules under the One Big Beautiful Bill, which changed some of the thresholds and phase outs. So don't wait until last business day of the year to think about this. If you already know you're going to give, doing it intentionally can make the numbers work harder for you. Move number five, tax loss harvesting before the clock runs out. Now let's talk about tax loss harvesting, which is basically turning bad investment days into smaller tax bills. If you have investments in a taxable account, things like individual stocks, ETFs, mutual funds, or certain other assets, and some of them are down compared to what you paid, you can sell those positions at a loss and use the loss to offset gains. Here's what that looks like. If you have $10,000 of realized capital gains this year and you realize $10,000 of capital losses, those gains and losses can cancel each other out. And you may owe zero tax on those gains. If your losses are bigger than your gains, you can generally use up to $3,000 of net capital losses per year to offset ordinary income like wages or business income, and then carry the rest forward to future years. So that means a painful position in your portfolio might at least help reduce your tax bill. There is one very important rule here called the wash sale rule for securities like stocks and many funds. If you sell something at a loss and then buy the same or a substantially identical investment back within 30 days before or after the sale, the loss may be disallowed and instead added to the cost basis of the new shares. So this is not something to wing blindly. And just like the other moves in this video, tax loss harvesting is a calendar year strategy. The sales have to actually occur by the end of the year to count for this year's tax return. Once we hit January 1st, those sales go into next year's return, not this one. And here's a bonus move. Clean up your books before the year is done. This last move isn't glamorous, but every successful business owner I work with is glad they did it. Clean up your books before the year ends. That means reconciling your bank, credit card accounts, making sure your income and expenses are properly categorized, separating out any personal charges that accidentally hit the business card, getting your receipts organized and invoices organized, and updating any mileage or reimbursement logs. And you ask, why now? Because good bookkeeping is what allows you to prove your deductions, spot additional write-offs you may have missed, and avoid obvious audit red flags and give your tax professional the clarity they need to plan for you instead of just doing data entry. See, taking even one focused hour in December to clean things up can save you a lot of stress, time, and money between January and April. So here's the truth. April is when you file your taxes. December is when you actually save on taxes. If you don't make these moves before December 31st, you simply lose the opportunity for this year, and the IRS will happily keep the extra money you send them. If you want help applying these strategies to your specific situation, your entity structure, your income level, and your goals, send me a DM with the words tax moves, or click the link below to book a year-end tax planning call with my firm. And if you found this helpful, hit the like button, subscribe to this channel, and share this with another business owner who needs to hear it before December 31st. See you on the inside.